Now let's apply what we've learned by recording transactions 6 through 8 for the garden spot. The garden spot had sales of $400,000 during the year, $315,000 of which were cash sales, and the remaining $85,000 of which were sales on account. The inventory that they sold had originally cost a total of $240,000. I'm going to suggest that we treat this transaction as two parts. The first part will be the recording of the revenues or the sales that occurred during the year, and the second part will be recording the cost of the inventory that had been sold. So let's start by recording the sales. When we record revenues or sales, we are going to increase retained earnings. So I'm making a right side entry to retained earnings, which is an owner's equity account. I'm going to put a notation in this entry to remind myself what the entry is for. Here I've made a notation that it's revenues. Retained earnings is increasing by $400,000. Now on the left side of the entry, I'm going to record an increase in the asset accounts which the company received in exchange for the sales. It received cash for part of the sales, and it received an accounts receivable or a promise to pay from the customer for the remaining part of the sales. So let's make a left-hand side to cash, which is an asset account. It increases by $315,000. We'll make another left side entry to accounts receivable. I've abbreviated that as AR. An increase of $85,000. So accounts receivable, again, is that account we use when customers purchase something. We record revenues, but the customer hasn't paid yet. We might even want to call it how much the customer owes me and call that the asset account. But typically the accounting lingo is accounts receivable. Now notice that the total of the left sides of the entry is equal to $400,000, which is the same as the total of the right sides of the entry. So we feel comfortable about that. Now let's post this entry to the T accounts. Let's start by posting the left side entry to cash for $315,000 into the left side of the cash T account. I'm going to make a notation out to the left here that this is associated with transaction 6, but I'm going to go a little bit further since I have suggested that we treat this transaction in two parts. Let's call the revenue part 6A. So anything associated with this entry we will label as 6A. The next thing I need to do is post an increase in the accounts receivable account as a left side of $85,000 to that T account. We haven't used that T account yet, so I'm going to create it. Accounts receivable, asset account. Now recall this is going to have a beginning balance, but it's 0. And we're going to post the left side entry to the accounts receivable account on the left side of that T account. Again, I'm going to label this 6A. And then finally, I need to post the right side entry to the retained earnings account and to the retained earnings T account. But notice we don't have that yet in our workspace because we haven't used it yet. So I'm going to create one. Retained earnings. It's an owner's equity account, so I've put it in the owner's equity section of the workspace. It has a beginning balance of 0. And I'm going to post the revenues to the right side of that T account. Again, I'm making a notation that it's associated with transaction 6A. One additional thing I'm going to suggest that you do is anytime you make a notation or an entry into the retained earnings T account, put a notation out beside the entry in the T account that's consistent with the notation that you gave to the entry in the journal entry. So I'm going to put revs as an abbreviation for revenues. Both sides of the equation increased by $400,000, so we remain in balance. Let's go to transaction 6, part B. Okay, recall that part B is recording the cost of the inventory sold. Okay, so when we record the cost of inventory sold, we record that as a left side entry to retained earnings. We'll call that cost of goods sold. Retained earnings decreases, because this is an expense, by $240,000. Now the corresponding right side piece to this entry is the reduction in the inventory asset account. So inventory, which is an asset, decreased by $240,000. Let's post these to the T account. The left-hand side to the retained earnings account of $240,000. We'll make a notation that that's transaction 6, part B, and we'll put out to the left here that that was the cost of goods sold expense. Let's record the reduction in inventory as the right side entry to the inventory T account. We'll put a notation that that is transaction 6, part B. Let's make sure that assets continues to be equal to liabilities plus owner's equity. Assets decreased by $240,000 because we sold inventory. We reduced the inventory balance. Owner's equity decreased by $240,000 because of the cost of goods sold expense that reduced the retained earnings T account. So again, both sides of the equation go down by $240,000. We remain in balance.